Hi everyone, I am Harman. Today's presentation is on book reading and current affairs. We will begin with the book Beating the Street by Mr. Peter Lynch. Mr. Lynch is one of the most successful investors in the world. He is known to manage the Fidelity Magellan Fund and grow it at an exorbitant CAGR of 29% during his 13 years duration. Moving on to the first topic, why do stocks outperform bonds? Equities are known to offer superior returns because they have unlimited upside potential. Bonds are attractive only when the government security yields exceeds the S&P 500 dividend yield by 6% or more. Bonds give fixed returns, but they can still prove to be unattractive and risky when the inflation rates exceeds the fixed returns offered by the bonds. In such a condition, the bonds lose their real value. Bond funds that invest in government bonds are really unattractive. Investors can simply take out their money, save the charge fees, and invest independently into government bonds. Moving on to our next topic, savings and loan institutions. They are considered to be attractive because the book value per share is greater than the IPO price per share. This is because SNLs don't have any owners. They are controlled by mutual depositors. So when the SNL company decides to go public, the insiders often convert their control into actual equity ownership, and hence the IPO price is quite lower. 90 days NPA and high risk real estate assets are often seen to judge the survivability of an SNL. SNL acquisitions boost lending power. SNLs have a regulatory cap that their equity by asset can't exceed 10%. So, an SNL with a comparatively higher equity by asset acquires an SNL with a lower equity by asset, and the merged entity has a comparatively lower equity by asset, and this gives them the headroom to lend more money. Moving on to securitization, banks give mortgage loans to home buyers, but banks don't want to fix their money for 25 to 30 years into loans, and they want instant liquidity. So they sell these loans to Fannie Mae. Fannie Mae collects these loans, pools them, and forms a mortgage-backed securities. Fannie Mae sells these MBS to investors. Investors purchase them because Fannie Mae is giving them a guarantee that even if all the loans of the MBAs default, then still the Fannie Mae will repay the invested amount which was invested by the investors. Fannie Mae offers Fannie Mae charges a spread for this guarantor title, and it is called as the spread. Investors bear the risk of interest rate change. Now I will hand over the presentation to Swaraaj, who will talk about the topics of allocation of funds and retails and restaurants.
Let's look at a few key factors that one must consider while allocating funds. First, successful allocation begins with while understanding your risk appetite, which is based on your willingness to tolerate your losses, your financial capability, and your time horizon. Generally, bonds are tend to be fitted in low risk appetites, while the stocks are suited at higher ones. Next, you must diversify your fund strategy by investing across multiple categories like growth, value, situation funds. As no single market strategy works all the time. Diversification also helps you avoid the frequent switching, which may impact the returns. Next, while selecting, do not pick just mutual funds based on 1 to 5 year performance. Instead, you should look at the funds which deliver steady returns over the period of time during both bull run as well as bear run. This ens- and you must also ensure that while you evaluate the funds, similar type of funds should be evaluated to maintain the fair comparison. Be aware that the sector funds aren't for everyone especially for the people making this casual prediction, as return can collapse if the outlook is wrong. Although industry insiders may use them effectively to spot the sector turnarounds. For example, a plumber who is very well versed in the prices of copper has easier time predicting the future price and can easily benefit by investing in such funds when the prices may rise. Another reliable strategy is to focus on the dividend growing companies, those who have raised the dividend for consistently more than 20 to 10 to 20 years. Now, moving on to the retail and restaurant side, I would like to discuss a key critical operating indicator. I would like to discuss a critical sign of retail health, the same store sales. SSS refers to the sales done by the old stores. Rising SSS means that old stores sell well more each year, indicating a healthy business. Also look for companies which have low operating cost. Cutting the cost while expanding new stores demonstrate superior operating efficiency and efficient management. Analysts must also revolve an analyst must also evaluate saturation by determining the total numbers of store to see if the market is approaching the limits. Retail and restaurant chains companies grow steadily and are predictable as they continue to add new stores to the growth remains intact and compounds the wealth consistently over a period of time. Inventory management is another crucial point to look at. An unusual high buildup of inventory against sales can signal weak consumer demand or possibly management cover up. Finally, while tracking restaurant as well as retail chains, note that aggressive expansion can often lead to high cost and poor location decisions, while steady growth is what truly creates the value. You should track the same store sales, new store performance, and the debt level of these chains. I would like Mustafa to help us understand the principles of investment discipline and portfolio health and the learnings derived on valuation based learnings. Thank you.
Let's understand what to do when stocks fall. So first of all, check did something change in the company due to which the market has reacted negatively. If the business growth prospects remains good and nothing has happened, then stay invested or add more because fear-based selling hurts long-term returns. Also, constantly track the companies in your portfolio and the companies whose growth prospects don't look good, sell them and hold the ones that continues to perform good and will also perform better in the future. Now you don't need many stocks. You just need a few great ones to cover losses and you still earn good returns over and above those losses. Now, some people forget the stocks which they once owned and treat it as a one-time investment, which is a big mistake because businesses keeps evolving. So stocks which you sold might become good picks again. So consistent tracking is important. Now, most active fund managers fail to beat the index because they avoid bold calls or and stick to the popular or index stocks. This keeps that performance close to or below the index. Only a few are able to outperform, and that happens when they select the right index stocks and the weightage to those stocks in their portfolio is higher than the weightage in the index. Now, let's understand valuation based learnings. So, when a sector becomes overvalued despite weakening fundamentals, it's smarter to shift capital into sectors where fundamentals are improving, but the market hasn't noticed it yet. Now, if a stock has gone up and it is expected to do better in the coming time as well, then buying more makes sense. But if a stock has risen but future prospects are not good, then buying more just because the stock is rising is a bad decision. A useful way to judge valuation is to see how a stock price moves relative to its earnings. When the two stay close, the pricing is usually reasonable. But when the price is far ahead of earnings, future returns are often weaker. Now, you shouldn't pay a PE higher than the company's growth rate. For example, paying 40 PE for a stock growing at 25% increases your payback period compared to buying it at 25 PE. Now, say there is a company A which is growing its earnings at 15% and trades at 30 PE, and company B grows at 30% and trades at 40 PE. So now the fast growing company B can justify a higher P and still deliver better returns than the slower growing one. Now, Vandita will take us through Peter Lynch's investment philosophies.
Now let's look at one of the most interesting ideas, that is finding good companies in lousy industries. A lousy industry is basically an industry which is declining or has stagnant demand. So what happens? The economics are very tough, so weaker players start exiting. When an industry is very popular, everyone enters and the profit pool gets divided. But in a declining industry, the opposite happens. It, players exit, and the remaining companies can actually gain a larger market share. So, how to find winners in such a tough environment? You must look for a low cost operator. Then, such companies must have very strong balance sheets. They must have lower debt and higher working capital efficiency so that they can ferry bad times. An example for this could be Southwest Airlines, where it used to operate in a very bad industry, but because it was a low cost operator and it had cut down on extravagance and frills and maintained good operating efficiency, it could remain profitable. So, if you see such traits, you can not just survive the lousy industry, but actually win big in it. Now, let's look at idea generation and one of the tools extensively used by investors, that is scuttlebutt. One of the ways of idea generation is after an IPO, the excitement fades and the reality sets in. So you can find good companies with strong fundamentals at very reasonable valuations, and that is when you enter. Second is markets tend to overreact to fears. Good businesses get beaten down to very low prices. So you can buy such businesses when you see early signs of recovery and you can hold on to them with a long term view. This can give you outsized returns. Third, when you come across a very risky situation, you should analyze the risk reward ratio and see if the investment is worthwhile. And this can give you a very asymmetrical opportunity when the upside is larger than the downside. Fourth is instead of looking at overhyped and overtracked stocks, you should look for underfollowed and under-owned stocks which are very financially strong. On the right side, we see scuttlebutt, which is used extensively by Sir Peter Lynch. So scuttlebutt is basically going beyond reports and talking to people who can actually see the changes before the markets do. You can talk to suppliers, distributors, industry reps, even your competition and the management teams. Sometimes the best insights can come from outside the company that you're studying. One of the best questions that you can ask is, which is one of the company that you admire the most in the industry? And this forms a very good idea generation point. Scuttlebutt reveals trends, early ons, and finer details which might get missed in the financial statements or take time to show up in the financial statements. Now, Gautam will take us to the concluding parts of the book where he'll help us understand how to analyze retail companies and some of the key learnings from the book.
Hi, let me start by explaining you all what cyclical sector are. These are industries whose performance goes up and down with the economy, like steel, auto manufacturing, chemical industry, etc. Generally, you have seen in most of a company, a lower P/E ratio usually means that the stock might look cheap or undervalued. But in cyclical company, a lower P ratio usually can actually be a warning sign. So commodity cycle follow demand and supply cycle. When demand goes up and supply stays same, the price will increase. And when demand stays same and supply goes up, the price will fall. Because demand and supply cycle change over time due to economic condition, weather, technology upgradation, etc., the commodity price goes to a cycle. So in majority of time in downturn, a weaker or a smaller player often leave the industry or they cannot be able to survive this bad phase. So this give an opportunity for a stronger player. If they can survive this bad phase, they can be able to capture a higher market share in turnaround. So the most important question you should ask a company is company balance sheet is strong enough to survive the next downturn or not. This is all about the cyclical sector. Now let's move to utility stock. Utility stock represent company whose services are necessary regardless of the economic condition. This company tends to have stable or predictable cash flow, regular dividend, lower volatility, and regulated pricing. The utility stock may drop suddenly when something goes wrong, like power plant accident, any big order delay, or spending far more money than they have planned. These problems scare investors because they may cost a lot of money for a company, but utility provide essential services, so government usually step in to help them and regulator allow them to raise rate so they can recover their cost. When the utility company goes into trouble, they usually cuts its dividend. This may cause the drop in share price. So buy the utility stock after the dividend is cut, because at this point the stock might look cheap and company usually working on a recovery plan and regulator help them to stabilize. After company fix its problem and improve its financial, they usually increase its dividend. A management only raise dividend after they are sure they are stable enough. Now let's quick now let's quickly learn now let's quickly look at the key learnings from the book. First, core investing principle. In that, we should invest in a strong company. Our wealth should grow shortly diversify your portfolio in different risk perspective, be stay be calm and objectively. Second, what drive economic return? Economic returns come from earning growth, dividend yield, PE rating, PE re-rating, and price appreciation. Third, debt and cash flow check. If a company carries huge debt, its cash flow should be sufficient to cover both interest and principal. A strong balance sheet is essential for navigating downturn. Fourth, business quality indicator. A higher inventory turnover shows a strong demand. A industry needing higher investment and tough to replicate operation create strong entry barrier. Healthy cash flow help company to survive downturn. And fifth, continuous reviewing and valuation discipline. Buying a company isn't enough. You must regularly and systematically review whether the stock is still attractively valued and understand what is driving the revenue growth. This is all about our presentation of the book Beating the Street by Mr. Peter Lynch. And now Swaraj will take you from here on economic theme and economic tracker.
Now we will begin with economic trackers and theme, starting with economic trackers. The capacity utilization has reached a level that warrants new expansion. The substantial surge in order book confirms that necessary. This expansion may occur within few quarters, a perspective strongly supported by the latest PMIs, manufacturing as well as service. While we note the recent fall in indices for steel, coal, or cement, and cement, the key component of 8 core sector, is likely due to the temporary dip in attributed to the festive season holidays. Critically, the underlying growth is robust, backed by strong credit to industry, the service sector, and healthy credit to deposit ratio. In simple terms, the Indian economy may have full order book and have high confidence. Many firms also have necessary bank funding secured. India may be firmly on a track for expansion provided that the pattern improves or continues. Now, we will begin with the themes, starting with gold and AI. Let's talk on gold. Gold is a renowned asset acting as a safe haven during crisis and used for hedging against inflation. It has low correlation with equities, making it a strong portfolio diversifier. Historically, gold has proven its worth, outperforming the Nifty 50 in INR terms over the last 25 years. When considering how to invest in gold, the sovereign gold bonds are particularly attractive as they offer benefits of physical gold while also providing additional benefits of interest returns and eliminating the storage cost. Moving on to the artificial intelligence, we are now witnessing a fundamental shift in global economy and specifically the IT sector. The adoption of AI boosts the productivity, strengthens the exports competitiveness, and improves the profitability. However, there is a change in the workforce. Companies are now only need few high-skilled laborers and AI-powered workers rather than going for large teams of average coders. Consequently, employee count of major IT firms have been flat over the last few years, and salaries have barely kept up with the inflation. If this continues, the income of approximately 50 lakh IT workers could become stagnant or shrink. India's GDP growth would fall from 5 to 8 to 7% down to the 4 to 5% bracket, severely hitting the young workforce. Furthermore, a weak ability to create job may lead to total IT employment and plateauing or declining, resulting in a weaker consumption. One more thing I would like to say is that Indian economy should focus on manufacturing side in order to cater the potential unemployment and reduce the probability of mishap. The shift. Now let's talk about the capex frenzy. Big tech companies including Apple, Microsoft, Meta, Alphabet, and Amazon have collectively spent around $1 trillion on AI in the last 5 years. This spend now exceeds the capital expenditure of entire oil and gas industry. Despite the opportunities, there are significant risks. Michael Burry has pointed out few concerns regarding the earnings quality and noting the AI revenues did not cover are yet to cover depreciation with server life extension and artificially inflating the profits. I would now like Mustafa to talk on IPLI and China plus one strategies. Thank you.
Let's understand China plus one. So, due to rising wages, political risk, and pandemic disruptions, global companies realized that depending on one country is too risky. So, they decided to add at least one more manufacturing base like India, Vietnam, or Mexico to reduce the supply chain risk. Now, India must attract the firms moving out of China by investing in critical sectors like semiconductors. Also, they should keep importing cheap Chinese products because it will lower our cost, but local capacity should also be built. Now, in H1 of FY26, India's rare earth magnets imports fell over 50% because China restricted supply of heavy magnet exports. As a result, companies shifted supply to light rare earth magnets, which are easier to source from multiple countries. Now, China continues to dominate critical minerals like rare earths. This makes diversification low and leaves Western countries exposed to high supply chain risk. Now, Indian pharma companies are moving beyond low margin bulk drugs into CDMO services. Now, as global pharma companies are also looking for diversification, the Indian pharma firms will benefit from this. Now, India is also looking for reopening the Chinese FDI, which will help them enter into global supply chains. Now, due to this strategy, FDI in China is falling, but to keep India attracting these firms, they need to, it will depend on India's reforms, infrastructures, and faster approvals. Now, let's understand production linked incentive scheme. So, it is a government program where manufacturers are given incentives on increasing manufacturing output above a set targets given by the government. Now, as Apple products assembles iPhone production in India, this helps in attracting other global firms. Now, China built its dominance because of Apple's high-tech manufacturing ecosystem there, which gave them control over key supply chains. Now, India approved a 7,280 crores rare earth magnet scheme because these are essential. These are used in essential parts of EVs, wind turbine, and defense equipments and electronic devices. Now, earlier, India used to assemble electronic components, but now the companies will manufacturing components locally, and the government has approved 7,172 crores worth of investments. Now, in textile sector PLI, 17 companies will invest 2,074 crores, mainly focusing on man-made fiber garments, fabrics, and technical textiles. Now, India's battery PLI target of 50 gigawatt hours by December 24 has achieved only 1.4 gigawatt hours. So they have extended deadline by 18 months. The reason is the issues in supply chain, domestic supply chain, as the key battery materials are still mostly entirely imported from China and a few other countries, and the companies faced supply issues.
Now let's understand the Q1 FY26 GDP growth of India. In Q1 FY26, the real GDP grew by 7.8% and the nominal GDP grew by 8.8%. The reason behind the growth are: first, manufacturing momentum. A strong government push via PLI scheme boosted sectors such as electronic, auto, pharma, and renewable energy. And higher domestic demand for car, two-wheeler, electronic, and consumer durable helps the overall GDP growth. Second, service sector growth. Service sector deliver nearly a double-digit growth driven by urban demand, digital consumption, easy credit availability, and business activity revival. Third, demand surge across consumers and businesses. The final private consumption expenditure rise by 7% due to better income, rise in income, better job creation in service and manufacturing sector, and softer inflation. The gross final capital formation grew by 7.8% as firm invest in new plant, technology, and equipment. Fourth, lower inflation. Lower inflation help consumer spend and invest more freely because prices are stable, and any improvement in economic activity will directly impact the overall GDP growth. This boosted the purchasing power, consumer spending, which overall supported the GDP growth. Fifth, exports support. Export added a modest lift, partly from the firm front-loaded shipment ahead of the global tariff hike. The Q2 FY26, the second quarter FY26 GDP number are: the real GDP grew by 8.2% and the nominal GDP grew by 8.7%. The reason behind the growth are: manufacturing boom. The manufacturing sector grew by 9.1%, lifting industrial output, job, investment, and supply chain. Second, service sector growth. Service sector grew significantly, especially in finance, real estate, businesses, and supported revenue and employment growth. Third, rural and urban consumption. Higher spending on essential, durable, discretionary goods and strong vehicle sale and import signal robust demand. Investment rise. A GFCF rise by 7.3% shows stronger spending in on machinery, building and infrastructure, boosting current production and long-term capacity. Fifth, construction and utility growth. Construction grew by 7.2% via infrastructure, real estate and urban projects. Utility also added to momentum. This is all about the GDP growth of Q1 and Q2 of FY26. Now Harman will explain you about tariffs.
Tariffs are the taxes imposed on imported goods to make domestic industries more competitive. US is majorly imposing tariffs because of the breakdown of multilateral trade rules by countries like China. Additionally, US is suffering through major problems like debt to GDP above 120%, stagnant median wages, and trade deficits due to the US reserve currency rule. US is focusing on imposing tariffs to boost local manufacturing, make US self-reliant, and finance the higher debt cost. But US won't be able to fulfill its goal by imposing tariffs because this will lead to a loss of economies of scale, and global firms will pass on the cost and to the consumers. India should tackle China by launching PLI schemes, industrial policies, and focusing on growth sectors like lithium ion, artificial intelligence, semiconductor, and solar cells. India's textile industry was significantly hurt by the 50% tariffs levied by the US on Indian goods. US has also hit Russia by imposing sanctions on Rosneft and Lukoil, due to which the oil trade between Russia and India dropped by 66% in November. India is diversifying exports to Africa and Latin America and has launched a 25,000 crores export promotion scheme to make MSMEs more competitive and give them more incentives. India has also signed a major US deal of LPG gas, in which India will be importing 10% of its LPG gas requirements from US to reduce the trade deficit between India and US.
I'll quickly walk you through RBI's recent rate actions. In this easing cycle, RBI has cut the repo rate to 5.25% and the CRR to 3%, and has also injected 5 trillion into the banking system if we include all the open market operations and the forex swaps. So when the RBI cuts the repo rates or the CRR, the cost of funds for the banks decreases. It can even lower the lending rates because the 45% of the loans are repo linked. Even the deposit rates can decline because the liquidity increases. This has broad-term effects on the economy. Markets react very positively, consumers can get more disposable income, and the economy gets a boost. Now, on the right side, we see some of the reasons why India's growth can keep on increasing. First, the working age population has been increasing. Then there's been trend where the nuclear households in India are growing, so there's more consumption from there. Then India is a very low penetration company with low per capita income. So when the income rises, the demand will also follow. Fourth, GCC exports are rising and the remittances from outside are also increasing, which keeps our current account deficit at a healthy level. Some of the learnings are we must look at the market breadth to understand the true picture of the market, and also must have realistic expectations, because if we look at the returns of long-term rolling periods, then they have been very moderate. With this, I conclude our presentation. Thank you everyone for all your time and patience.